This is the Rich Dad Radio Show, the good news and bad news about money. Here's Robert Kiyosaki.
Hello. It's Robert Kiyosaki, the Rich Dad Radio Show, the good news and bad news about money. And we broadcast from gorgeous Old Town Scottsdale, Arizona, where right now it's raining, which is a blessing for the state because we're all usually very dry and dusty. But anyway, we have a fantastic program for you today because unless you're living under a rock, you may have been watching what the coronavirus has been doing to the markets. And the question is, what lies ahead in the future? I mean, is this for real or will it just bounce back? Is it time to just buy the dips, as they always tell you, and say, don't worry, just invest, buy, hold, and pray for the long term. So if you believe that garbage, I have a bridge here in Phoenix you can buy. We don't have bridges, but you can buy it anyway. Anyway, our guest today is an old-time friend, person I respect a lot. He is known as a forecaster. His name is Harry Dent. He's the best-selling author. His latest book is 0 Hour, Turn the Greatest Political and Financial Upheaval in Modern History to Your Advantage. He's called The Great Boom Ahead, and it did boom. And then he calls for the Great Bust Ahead, and now it's busting. So, ladies and gentlemen, if you want to see and peer into the future, Harry Dent's the guy. Now, I'm not saying he's always right, but he always stretches my brain and causes me to look differently at what's going on in the world today, especially in the world of money. And for all you old guys like me, if you're a baby boomer, not only is a coronavirus after you, because it only kills old guys, but it's also going after your retirement. So this is a good time for the baby boomers, the generation that had it the best of any generation in history. If you're an American baby boomer and you didn't strike it rich, you did something very wrong. So Harry, once again, welcome to our program. I can't wait to hear what you have to say about the future. I'm sure you're going to have some very happy news for all of us. Yep, as usual. Yeah, nice to be back, Robert. That's good. So this is a trick question I have to ask you, okay? The standard pitch, from people in the world is, go to school, get a job, work hard, save money, get out of debt, and invest for the long term in a well-diversified portfolio, stocks, bonds, mutual funds, and ETFs. So if you're a financial planner and you've been telling people for the last 30,000 years, invest for the long term in a well-diversified portfolio, stocks, bonds, mutual funds, and don't worry, the markets always bounce back, buy the dips. It's going to be probably a V bottom, which means it goes down and comes right back up, or a W goes up, down, and then back up again, which it has done over the last, let's say, 50 years. So if you're a financial planner and your clients are calling you and you've given them that advice of invest for the long term in a well-diversified portfolio, stocks, bonds, mutual funds, what are you saying to them today, Harry?
Well, I'd first say a financial advisor is going to be more hated than I am currently for forecasting the end of this bubble boom when it happens. And that is true most of the time. But what my work shows, and clearer than a bell, clear as your heartbeat every second, generational booms come about every 40 years, technology surges every 45, and then big bubbles every 90 years. When you get at these key turning points like the late 60s in stocks or the roaring 1929 in stocks, or now, stocks go down, Robert, and they don't get back to those levels for 23 to 25 years. And I think this time, with slowing demographics in the U.S., we may never see the Dow higher adjusted for inflation than it is recently. So this is not the time to sit through it. These type of long-term corrections are crashes after bubbles. They're going to be 70 to 90%, like 29 to 32. That, by the way, not small cap stocks or penny stock, blue chip, leading stocks like General Motors, Ford, and RCA back then went down 89%, the Dow, in 2.7 years, and took until 1953, 24 years later, to get back to even. So when a stockbroker tells you that, Harry, he doesn't understand.
Harry, hang on. You got to take a breath here, man. So what Harry is saying, in 1929, when the crash came, if you were holding and waiting for the market to come back, so in 1929, the Dow was at 381. It took approximately 24 to 25 years to get back to 381. And when I was a kid,
Right, adjusted for, yeah.
So I was in 1950s. When I was growing up, most of the people who were part of the Great Depression, my parents, and the people who were pounded by the Great Depression and the stock market crash, they were never in stocks. They were so gun shy of stocks. And then in my generation, the baby boom generation, they brought back this thing called the 401k, defined contribution pension plans and all this, and the stock market took off. So the baby boomers are caught with the proverbial pants down, and now comes the next big crash, which you've been forecasting for a long time, Harry. So what you're saying, this one might be a long one.
Yes, because this is the culmination not only of the baby boom, gigantic, as you were hinting, the largest generation in history. And it wasn't just U.S., it hit globally. To grow up and earn and spend money, which is totally predictable. Average person peaks at 46 for the baby boomers and spending 47 for the millennials today. And then decline. So we started to see that decline in 2008.
Harry. This is the Rich Dad audience. They're like me, a little slow. You got to speak a little slower. So what you're saying is that when a person hits 46, that's when they're at the peak earning and spending, and millennials is 47. Yeah. Is that what you're saying?
Yes, the average person for more affluent people, college-educated professionals, it's more like in the mid-50s. But still, yeah, average 46. So baby boomers hit that peak collectively in 2007, something I predicted like 20-some years before that. And we've been, guess what, we went down, big crisis, worse since the Great Depression, but not as bad because they printed so much money to stop it. And we've been living on quantitative easing ever since to make up for the slowdown in this generation's spending. That simple. And we're not coming out of it.
So let me go back again. So let's talk to my generation, or the boomers, what would you say to them if they drank the Kool-Aid? Let's say they have a 401k or an IRA, one of those things, a Roth IRA. They've seen their portfolio per se go up, and now it's crashing. What advice do you have for them? I mean, do they stay in or do they exit? And we don't give advice at Rich Dad, but I want to hear your advice.
Yeah. No, you get the hell out, period. I think you may have one more little run left. Could be a couple months, could be a couple weeks, because the Fed's pumping in more money than ever with the repo crisis and now the coronavirus. But I think this is the death knell for the stock markets. They can print money to stop a recession, to stop banks from failing, companies from failing, even stocks from crashing too much normally, but they can't stop this virus from spreading, and it just kills business. Businesses stop, people stop traveling, people stop spending. I mean, my wife's not going to even go to a woman's stayover tomorrow night because they're all coming in from New York, and she's, she might get the virus, and she's over 60 like I am, and that's what it hits. It's old people, like you said earlier. So this is something they can't fight with money printing. They have kept this bubble going far beyond when it should have peaked in 2007. And now they've got something that this doesn't work on. So I think this is it. So you have to get out of the way.
So Harry, like I was talking to this young guy. He was he's a laborer. He was painting parts of my house, and he says, I bought a house like you told me to back in 2011. He bought it for I think $100,000. I'm using round numbers, and now it's $300,000, and he has no retirement. He says, what should I do? And I said, should I sell my house? And I went, once again, ladies and gentlemen, at Rich Dad, we don't give financial advice. And I definitely couldn't advise this guy. He's probably only 40. He's got 3 kids. He's got a job painting houses. He's got no stocks. You and I are calling for a 25-year possible depression, long-term deflation. What do you say to people? Because he said if he sells his house, I said, where do you go? What are you going to do with that money? Let's say you have $200,000 and you got to pay capital gains tax on it. What are you going to do? He was clueless.
Well, I got some simple rules, Robert. I have become a bubble expert since the tech bubble crashed in early 2000, on top of demographics and technology and all these cycles, because we are in a bubble era. And the last bubble era we saw was the Roaring '20s. So nobody's lived in a bubble before, and real estate was not the bubble back then because you couldn't borrow money so easily against housing. In fact, it was very difficult. So now it's everything. The rule for housing is real quick. Bubbles go back to where they started. That house, if he bought it at the bottom at 111 and now it's worth 300K, my rough estimate is going to go back to near that level. If he's comfortable sitting through 189,000 potential decline in something he probably has a mortgage against and maybe some home equity lines that he went on deck to, fine. I think anybody with any brains would say, oh, no, I don't want to sit through that one. Oh, and by the way, the demographics, I've got a new real estate model that doesn't just project peak spending like other consumer categories. I have to subtract the dyers. And guess what? Baby boomers are now dying at unprecedented rates and will continue to do so into 2039 or 40. That takes down the net demand, even takes it negative at some point for real estate. So homes are never going to appreciate like they did in this boom, even in the next boom. So it's better, especially older people who are retiring. A lot of baby boomers are realizing they didn't save for retirement because they're living in good times and thought they didn't need to. And now they're saying, oh, wait a minute, though. My McMansion, which I don't need now that my kids are gone, I can sell that, instantly fund my retirement plan, and rent my retirement home. I think that's really excellent advice to do that.
Oh, you think that's good advice right now?
I think real estate, my phrase in my newsletters and books, real estate will never be the same, Robert, when for the first time in all of modern history, the next generation has less peak buyers for everything than the baby boom. And in many countries, it's way less, like Japan and Southern Europe and East Europe and places in East Asia. So, you know, there's always been, bigger generations and more and higher mortgages availability and more people owning homes. Well, it's all the opposite now. Millennials don't buy as many houses. They don't buy as big a houses. Oh, they share cars. Well, next they're going to be sharing McMansions. They're going to be so cheap. They're going to be putting two millennial families splitting a McMansion into a duplex because they can buy a McMansion for a little more than a normal starter home, because they're going to crash the most. So real estate dynamics are going to switch. Stocks will crash, go back near new highs somewhere down the road. I don't think real estate will get to these prices ever again. So you better love that damn home if you're going to stay in it. I own nothing except my vacation home off an island off of Puerto Rico because it's a unique property. It's also gone from 25 to 5 acre zoning. And until I get that codified where I have 5 lots, instead of 1, I'd be stupid to sell it because there's probably 40-50% value add just from that. But I don't own real estate. I'd rather rent.
Once again, Robert Kiyosaki, the Rich Dad Radio Show. And we're listening to one of my dear friends, and one of the guys that always sees the future, good and bad. And he'll always tell you what he thinks, good and bad. That's Harry Dent. You know, he's author of The Great Boom Ahead and The Great Bust. And he's always right on because he taught me one most important word. It's called demographics. You don't have to predict the markets, just watch the demographics, the people. As an old saying goes, demography is destiny. And so the beauty about Harry is he watches the world. You know, he travels the world like I do, and he goes all over the world looking and talking. When you look at the demographics of certain countries, especially Japan, you know, Japan has been in a depression for 30 years now, Harry, or 20 years?
Yeah. 30 years. And real estate crashed 60-some% and has never even bounced with the millennial generation because more old baby boomers dying than millennials coming along in Japan because their demographics are even worse than ours.
So Harry,
that'll show people say, Harry, real estate can't go down 60%. Oh, it already has in Japan. Oh, it will always come back and go higher. No, it hasn't in Japan ever. 30 years later.
But they also have a problem that I think we're going to have too, is called demographics. I mean, they have a dying generation, and people are counting on the population of America or wherever country you live in to keep going up. And I don't know if
our
that's...
population is going to barely grow. Our workforce is not going to grow at all in coming decades. But the net demand, when I subtract the peak buyers, Robert, at 42, and subtract out the dyers at 78 to 80 from those peak buyers, net demand for real estate goes down for the next 2.5 decades. So there's no way real estate's going to go up like it did in the past. It'd be lucky to go up with inflation after this crash. And inflation means if it only goes up at inflation, which is more historically the norm in housing, then you're making zero real return, like gold.
Right. Once again, Robert Kiyosaki.
You can rent.
Well, our guest today is Harry Dent. When we come back, we have to go to a commercial break here. I'm going to ask Harry, so we're talking about millennials, talking about real estate. I want Harry to give advice right now. So let's say you're 60 years old. You have a 401k with, I think the average 401k for a baby boomer is $75,000. You can't live on that. And it looks like our pensions are defined benefit pension plans, for police officers, firefighters, and school teachers are about to go bust because they're bust all over the world right now. So Harry's going to come back and he's going to give financial advice for all you old guys like me. We'll be right back. Welcome back, Robert Kiyosaki, the Rich Dad radio show, the good news and bad news about money. Our special guest today is Harry Dent. He's infamous for his predictions because he uses demography or demographics to predict markets. And he talked about the great boom ahead because the baby boomers were just starting to boom. And now the boom boomers are about to bust and the markets are about to bust. So once again, you can listen to the Rich Dad radio show anytime, anywhere on iTunes or Android or YouTube. And please leave a review whenever you listen. And all of our podcasts are archived at richdadradio.com. We archive every one of our shows. Remember, we do not give financial advice or information or recommendations. But we are an education company. And if you have friends, family members, or business associates who need to hear this program, that's why we archive this show, so you can listen to this again. And since we're educational, you'll hear it twice as much the second time around. But also, if you have friends, family, and business associates, or that idiot brother-in-law of yours who's still hanging on to his stocks and his 401k, go to richdadradio.com and listen to this show again and discuss it with that idiot brother-in-law of yours. So we have our guest is Harry Dent. I have two questions, so ask him. The first question is, if you're an aging baby boomer and let's say you got $100K inside your 401k, or you're a police officer and you're up to $1 million and you got a home, what advice would you give to the aging baby boomer if now that the boom is about to bust and Harry is calling for a 24 to 25 year depression? So Harry, what advice would you give to that aging old guy like me?
Okay, first of all, Robert, correction. I'm calling for the worst of a depression that really started in 2008 with the Great Recession to hit between now and 2023, and then we'll pretty much be over it. We're just going to have to deleverage a lot of debt. But that's going to bring markets down and real estate down to reality, and a lot of bank failure and stuff, so we can grow again. It's called a detox, in the healthcare industry. When you get too much of a drug, a dangerous drug, you have to detox it out of your system. Well, we have dangerous debt, dangerous bubbles in everything from real estate to stocks to bonds that have to deleverage, and that's what's going to cause so much pain. So what you have to do, you get out of the way of the bubbles. That means if you're an aging baby boomer, you own the most real estate, more than most millennials, a bigger house, and have more equity in it. That equity is your treasure chest. I would sell, especially a larger house, either downsize, now that you're just a couple and don't have a kid because you're older, into a smaller house, or better, like the smartest baby boomers, rent that house in retirement. It's more flexible, lower cost anyway, and now you got a treasure chest to add to your 401k or pension plans or whatever retirement plans you have, and to take advantage of the greatest crash in history, which is going to bring stocks, real estate, and most assets down to levels you can buy long-term and make really strong returns again. You cannot make strong returns now, even if we don't have this crash I'm talking about. The best stock models say at these valuations, you're going to lose 2% a year over the next 12 years without my scenario of a crash of a lifetime. Stocks. So real estate is number one. People think, well, real estate, and it always comes back. No. I said that in the first segment, Robert. With baby boomers dying faster than millennials are coming along buying, and they're having different buying dispositions. They do know real estate can go down, unlike baby boomers. They do everything smaller and would rather spend more money on education and vacations and world travel and stuff. They're not going to be as bigger buyers, and there isn't the same wave to drive things up. So real estate is not only going to go down as much as 40 to 50% in a lot of places, it's also not going to come back probably at much more than inflation rates in the future. So it's not the investment it was for us boomers. Us boomers created the greatest real estate boom in history, benefited from it. Now we're going to be the ones dying and increasing numbers to tank it.
So
Harry,
if I have $100K in my 401K or $1 million in my defined benefit pension plan, would you sit tight and just ride it out, or would you get rid of your stocks too?
No, because that's going to be in stocks and bonds. The bonds, what I want to do, if I've got, in a 401k plan, you got, your stock funds and your bond. I want the most conservative long-term bond funds, AAA investment-grade corporates and treasury bonds. Those things, look at what the treasury bonds just did. They went up as much as stocks went down in this recent 19% flash crash. They were the safe haven. And they benefit from deflation. When these bubbles and when debt bubbles and financial asset bubbles deleverage, everything goes down except for the safest assets and the best currencies. And believe it or not, gold bugs, the best currency in the world of the major ones is the U.S. dollar. We're the best house in a bad neighborhood. We haven't printed anywhere near as much money as the Europeans compared to their GDP, and not even close to the kamikaze Japanese. So we're the best house. The U.S. dollar went up at the worst of the 2008 crisis when gold went down 33% and silver went down 50%, and stocks went down in real estate and everything. So you get out of stocks for sure. That is, the stocks will not come back to these levels we've seen recently when they finally crashed for decades, if ever. So you don't sit through this. You can buy the best stock in aging industries for the baby boomers, like nursing homes, assisted living, and cruise ships after all this gets over. And in the new boomers around the world generation, India and Southeast Asia are going to be the fastest growing affluent economies urbanizing in the future. So plenty of places to invest. You have to get out of the way of this bubble. Do not listen to your broker or financial advisor, because they're going to say this is just going to be another downturn and stocks will be at new highs in a matter of years. This will not be the case. Mark my words on this. If we do not see a major correction in the next few years, I am going to be, and I've always pledged to be, I'm going to retire in Australia on the Gold Coast as a limo driver and shut up and never say anything again.
You have good choice. I would go to. I'll join you in Australia, because you invited me on that tour through Australia. I just don't have the time to do it. But anyway, Harry.
Yeah.
Once again, Rich Dad does not make recommendations. These are Harry's recommendations, and Harry is, I would say, 90% of the time been accurate on his predictions. That's what he's known for. And he gave me that word, demography, or demographics is destiny. Just watch the demographics. And the old guys are getting old all over the world. I don't know if you know this, but we've been saying this for years. For the last few months. In the next 10 years, 2 billion old guys will be over 65. 2 billion, if they live that long.
Yeah.
So it's going to be a major demographic shift coming on planet Earth, regardless of what happens with Corona, Ebola, or the stock market. I have a final question to ask you. In your book, you talked about the trends, and one trend you talked about was, I think you called it terrorism or violence, that it lasts, I think, 18 to 20 years or something. And just as you called it, that was 9/11. It came just as Harry called it. He says we're entering the age of violence or something like that, or terrorism, and right on schedule, 9/11 hit. So what is that trend you watch?
Yeah, it is what I call an adverse geopolitical cycle when I was predicting the great boom, and I was way more popular, as you can imagine, Robert, saying first guy to say Dow 10,000 by 2000 in the late 80s and early 90s, first person to predict the collapse of Japan, which nobody would thought they were going to take over the world like they think China today. The last boom, though, from 2002 to 2007, I overestimated. We predicted the first one, and then the crash, and I said, oh, it's not over yet. We're going to go up until late 2007. And I predicted the Dow could go to 32,000. Well, it went to 14-something. And I realized by going back and studying stuff, there's a geopolitical cycle that's 17 to 18 years positive and then 17 to 18 years negative. I'd seen somebody put that, Ralph Acampora put that out many, many years ago, but it coordinated enough with my demographic cycle, I thought it was double counting. Well, it's not. It's a separate cycle, and stocks are 50% less valued at the bottom of the cycle. Now, we are at the bottom of that cycle. That cycle is bottoming in 2020. I think this Iran thing was a sign of it. I think that was the peak of the whole Middle East crisis and the massive intervention in the U.S. Not only is Iran and U.S. at a standstill, which is positive to me, but Iraq decided to kick the U.S. out of Iraq. If we get out of the Middle East and let them duke it out and solve their own problems, we're going to have a lot less problems in the future. So this is the one cycle I have. It turns up slowly, and then the demographics turn up in 2023. But the technology cycle is the one that's most peaking here every 45 years and now 90 years. The double cycle is the biggest bubbles. The bubbles come out of the technology cycles, and that's the one that's going to crash, and that's the one that lines up with 1929 to 32, about 90 years later. And that's the big cycle
Are
today.
those the FANG stocks? Facebook, Apple, Amazon, Netflix, and Google?
Yeah, all of those techs are the strongest in the bubble. They're still the best companies long term, but they bubbled the most. Same thing with the highest in real estate and, Manhattan or South Beach, Miami or San Francisco or whatever. The highest in places go down the most. The best stocks go down the most, and then you buy them, and then they do well again. You could have bought Amazon before the bubble in 2000 at 6. It went to 161, back down to 6, and then it went up to 2,000 and something recently. So you want to get out of the best stocks now. Of course, banks and financials are not as overvalued as the tech stocks, but they're going to get hammered because we're going to have the financial crisis that they prevented by printing $16 trillion starting in 2009. We're going to have it bigger than ever because they've only added 100-some trillion in debt, and particularly in emerging countries, which crashed the hardest. So, financial stocks are the ones to get out, and tech stocks the most, but all stocks. I looked at the 30s, Robert, even utilities and like Procter & Gamble, like consumer staples, went down because everybody gets fearful, and it's the price to earnings ratio that collapses more than the sales and the earnings.
Okay, so this is my question. I'm kind of worried about this terrorism thing, So you're saying that's on a decline? So like North Korea and
I think I think you have more like crisis over financial stuff and coronavirus, but I think the global stuff, all the wars in the Middle East and all this sort of stuff, I think that's going to calm down more. It's the crisis is going to be a bad economy puts people in dire straits. In my view, Robert, as you probably know, I see the greatest polarization in politics since the Civil War, the blue-red, polarity I see that is just going to erupt. It's another reason, other than lower cost of living, much better taxes, and better weather in Puerto Rico. I'm happy to sit out here because I tell you, when the economy goes down, the red and the blue people are going to get along a lot less well, and the red people have all the guns. So that's my question. So, given this coronavirus and if terrorism going down, is it safe to shop at Walmart now? No, coronavirus is just starting to hit. It has peaked out for now in China. It's just starting to hit. Guess where it exploded? Note where it exploded the most. Not in Vietnam or Southeast Asia or Philippines, other places around. It's more Korea and Japan, and now it's in Northern Europe, particularly Italy. What do Italians do? You ever been around Italians? They don't just shake a hand or give a little peck on the cheek. They give a big peck on each cheek, and then one right smack to the lips. And then God knows what they do after that. They are the ones that are having the highest death rates because they have such high human contact naturally. But it's the colder climates. This virus likes cold. It doesn't like warm. So I think by the summer, this thing could start to peter out. But, the next month, I think Kyle Bass said the other day, you think this thing's bad now. His advice, he's not going to do anything. He's going to wait a month and then look for bargains in the stock market or something. Well, I think it's going to take a lot longer than that. But I think this gets worse. There's no question. This is going to get worse. It is just starting in the U.S. It is exploding in Italy. Just in the last 2 days, they added another 156 deaths, another 3,000 infections. I mean, it's gone up 50% in infections and death in 2 days. Their death rate is 6.2%. China was 3.8. U.S. is at 3.5, but you know that South Korea and Singapore, who do immediate testing and try to catch it earlier, their death rates are less than 1%.
Well, they don't hug and kiss either. They're Asians. Remember that, Harry. They're very unaffectionate people. They don't hug and kiss, so that's why Italians are screwed.
Exactly. They don't hug and kiss. Exactly. They're the opposite of Italian.
Harry, once again, it's always entertaining and informative, and thank you for your your just outstanding outlook into the future, the good news and the bad news, and the Great Depression ahead, and all that stuff. So anybody wants to know more about Harry Dent, his website is dentresearch.com. And so, Harry, thank you for, once again, informing the people of the Rich Dad radio program. Thank you. Welcome back, Robert Kiyosaki, the Rich Dad radio show. Again, thank you to Harry Dent. His book is The Great Boom Ahead, now The Great Bust Ahead, and his other one is 0 Hour, Turn the Greatest Political and Financial Upheaval in Modern History to Your Advantage. And this is going to be the biggest bust we've ever seen. Once again, you can listen to the Rich Dad Radio program anytime, anywhere on iTunes or Android and YouTube. And please leave a comment or a review whenever you listen. And all of our programs are archived at richdadradio.com. And the reason we archive it is so you can listen to this again, because you'll learn more the second time. But most important, if you have friends, family, or business associates who need to hear this program, please go to richdadradio.com, listen to it, and discuss. And then you can make up your own mind of what you guys should do. Because I agree with Harry, we're going into a depression. And he thinks it's only going to be a short one. But I count the crash from 2020, he counts it at 2008. But it depends. The last depression lasted 25 years, 1929 to 1954, I believe. So this is pretty serious. And so please ask your friends to listen to this and discuss. And once again, Rich Dad makes no recommendations. We give no advice or stock tips or anything like Harry's recommendations are Harry's recommendations. We believe in think for yourself. So Sarah, what did you think about Harry?
Well, I mentioned after we let him go, I felt like I just did an hour's workout. A couple of things that I took away. I'm just a little bit older than the oldest millennial. So not that far off, and
just a kid,
just a 40-year-old kid. But one thing he was talking about was the real estate market and the replenishment rate, right? So boomers, like my parents, that was a big step in their life. They got married, they bought their house. If they were lucky, they stayed in that house, for the rest of their life. That's where they raised their kids. Millennials aren't buying that way. And so what's going to happen to the real estate market after he says all the buyer, the dyers, he calls them, the buyers aren't there. They're going to start sharing houses. And so that was an interesting perspective that I hadn't, for some reason, thought of before Harry mentioned it on the show.
Yeah, during my time, they were called Mac Mansions,
Yeah.
And I have several of those Mac Mansions, unfortunately. But there's, there's a term, I don't give a what. And the reason we're talking about it is because the reason we have the Rich Dad radio program is to prepare you for this stuff. And if the economy crashes, I'm going to get extremely rich.
Yeah.
It goes up, I'm going to get extremely rich. Now, to get there, I made a lot of mistakes. I lost a lot of money. I made some bad investments. Had horrible partners, a bunch of crooks along the way. But that's all part of the process of financial education. You don't just buy, hold, and become a multimillionaire. I don't want people to thinking. So the good news is no matter which way it goes, I'm going to get very rich. And then I'm going to roll all of my assets. Kim and I roll all of our assets into what's called a CRT, a travel remittance trust, and we'll pay zero tax on the whole thing. That's what financial education is.
Yeah.
And that's why with the Rich Dad radio program, the Rich Dad Company, is because financial education is your best asset. Unfortunately, don't learn that in school. Another thing my rich dad always said to me, and this is why we have this program, you can't teach a man to swim when he's drowning. So a drowning man cannot learn how to swim. And unfortunately, a lot of the old guys like me, thank God you're still a young kid, you have time to learn how to swim. But most of my peers, they're too old. They cannot learn to swim. And I think they'll go down to gurgler with many, many billions of baby boomers all over the world.
Yeah.
So I think that's the thing. But just know that the rich will always get richer, and the poor and middle class this time will stay poor. And as Harry wrote about the great boom ahead, the baby boomers boom is over. They're dying now.
And I think, so I read a lot of the feedback that we get on these shows, and you've been doing this radio show for many years now, and everybody's like, oh, Robert, you're saying the same thing. You predicted a crash. Da-dee-da. Not one of these people has heeded your warnings, because now they're drowning. You know what I'm like? This is the point of the show, is the financial education. And yeah, the message stays the same. We're saying the same thing, but because nobody listens. And so I think we're going to keep doing this until people start figuring it out.
Yeah, and it's really uncomfortable. You know, there's that old the fairy tale, Chicken Little. The sky is falling, the sky is falling. Well, I've been Chicken Little, but at the same time, I've been preparing. You know, so when I made a fortune when the market goes up, and I'm going to make a bigger fortune when the market goes down. That's financial education. Right. It's not buy, hold, and invest for the long term, a well-diversified portfolio of stocks, bonds, and mutual funds. And that's why I started this program, asking Harry Dent, if you were a financial planner, what would you say now? You know, buy, hold, pray. You got to be crazy. I agree with him. This baby is going to stay down. I don't think it's going to come back. I'll tell you why it's not going to come back. It's because when you look at, you know, today we have this election between Bernie Sanders, Biden, and Trump now. And what Bernie is saying is probably, I feel for Bernie's constituency, the guys that are voting for him. They have no health care. You know, and health care is the most expensive thing. When you start passing 50, health care gets more and more expensive because you get older. Right. So the biggest crash coming is going to be Social Security and Medicare. And those are estimated. I've seen some numbers as high as $200 trillion. And nobody's counting that. And the reason Medicare is going to go bust is, you know, what I talked to you about, we may have this guest on who's talking about what the food companies are doing is they're stuffing our food full of fructose and sugar. And sugar is not only poisonous, but it also makes you fat. And if you're fat, then you get obese. Then you have diabetes, heart disease, and all that. So I have all those diseases. And they're called the disease of the fast food generation. You know, I too ate a lot of Whoppers and Burger Kings and all this other stuff. So it gets more and more expensive. Yeah. So all you young people, please listen. You know, just because Harry says it's going to come back in 2025 or something, the next big typhoon is the dying generation, not the boomer, the dying generation. They're going to destroy Medicare and Social Security. So if you're sitting there saying, oh, well, Bernie's going to save me, Bernie Sanders or Joe Biden or Trump, I think you're solely mistaken. And if you're just watching the stock market, that's the biggest concern. It's not just the stock market, it's demographics, exactly as Harry talks about in his books. Yeah, that was I think that's the part of the show that I really liked that he talked about, because it isn't just the ups and downs. It's the wave of the demographics that changes everything else, which I thought was very interesting. And this is worldwide. You know, the plug my book, Who Stole My Pension? That's the biggest crash of all. It's going to be the firefighters, police officers, and school teachers. They have nothing. And they're like my poor dad, you know, or college professors, tenure. They got job security. You can't learn to swim when you're drowning. And all of those guys are going to start drowning within the next couple of years. And so are they going to invest for the long term? So the time to learn to swim is now. So if you're a young person like you That's what we encourage here at Rich Dad, right?
Yep.
So I'm going to get richer than ever, but unfortunately, like I'll just tell you what I've invested in. About 25 years ago, Kim and I bought this piece of property right on Camelback when the last crash, and it's a health club. And the baby boomers are so old now they can't even get to the health club. So we're converting it to an old age home, so they have a place to go to, because demographics is destiny.
Because your demographic changed.
Yeah, and they're going to say, well, what if they can't afford a healthcare home? Well, that's why we bought. Camelback is the best street in Phoenix.
Yeah.
And that's where the health unit's going to be. So it's all going to be these rich old guys who will move into and I'll be one of them, in this healthcare facility. So that's how you get rich. You look into the future, look at demographics, as Harry Dent talks about, and you base your predictions off of that. And you look at this, this coronavirus stuff. As you know, Sarah, I'm a prepper, so I have my I have my weapons, and because somebody comes to my house to steal my toilet paper, I'll defend it.
They can take your gold, but not your toilet paper.
But the other thing I've stored up, which most people don't know, is antibiotics.
Yeah.
And they come from China. So a little proper planning prevents piss poor performance. Just look into the future. Just do as Harry Dent says, look into the future.
Yeah.
Look at the demographics. Look at what people are doing. So the millennials, I'm still going to make a lot of money because my house is, I think, 8,000 square feet. I can chop that into 3 different units, different houses. So there's always something you can do, and that's what I'm saying. So don't put your head in the sand. Final words are Sarah. And,
great. This was a great episode. Always love hearing from Harry. And to quote Harry, he said, "Get the hell out of the stock market."
That's Harry, not Robert.
That's
Kiyosaki.
Harry's, not our advice. But I thought that was, straight to the point.
Yeah, I haven't been in the stock market for years because there was a divergence between the stock price and its underlying value. Phoenix real estate is booming because people are moving out of California because their pensions, which is the CalPERS, is going bust. So they're going to raise the taxes on all the Californians.
Yep.
So they're escaping across the border from California to Arizona and Texas. And real estate here is booming. So it's still pretty cheap. This woman sold her house for $750,000. I would have paid maybe $50,000 for it, but she was happy to get $750,000 for it. But she's building a $3 million house now. That's stupid. But anyway,
to each their own.
That's life. She's young. She's just got time to learn. Anyway, thank you all for listening to the Rich Dad Radio program. Once again, thank you, Sarah, and thank you, Harry Dent.